Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes time. Let's get to the stories we're following in the BNN Bloomberg newsroom. Oil prices have surged to their highest level in more than 2 years after a stark warning from Qatar's energy minister telling the Financial Times he expects all oil and gas exporters in the Gulf to halt production in days because of the conflict. The region has a key shipping route that has already been paralyzed, and the leader says a full shutdown could, quote, bring down the economies of the world. The Prime Minister Mark Carney signed a deal with Japan to expand energy trade and military cooperation. It also outlines a pledge to increase the flow of liquefied natural gas and liquefied petroleum gas to Japan and work together on nuclear energy and clean energy projects. Shares of Aecon Group seeing a spike, hitting an all-time high, up at this point more than 6.8%. The engineering and construction firm beat analyst expectations for the latest quarter with stronger profit and revenue, which climbed to over $1 billion or $1.5 billion. Aecon says the results were boosted by infrastructure demand and new contracts. AltaGas posted profit of over $560 million, beating analyst estimates. Revenue rose over 1% year over year to around $3.3 billion. The Canadian energy infrastructure company says results were driven by strong liquefied petroleum gas export volumes to Asia. And the market's beaten down again today by what is happening in the Middle East. The TSX down 552 points. That's 1.6% so far in the day. In the U.S., we have a 1.4 drop percentage-wise for the S&P 500. That's a 98-point drop. The Dow Jones also down over 1% today. And the Nasdaq down 1.7%. That is a 390-point drop on the day. Oil prices are surging, as we mentioned. Take a look at West Texas Intermediate, up today 12% or $9.81 to over $90. Let's go to Rick Rule on this. He's president and CEO at Rule Investment Media, and he joins us to talk some more about what's going on. Rick, as you saw, West Texas above $90 a barrel right now. Walk me through the fallout of what happens if, as predicted by Qatar's energy minister, Gulf production dead stops.
Well, in the very near term, basically 50% of the world's export crude go through the Straits of Hormuz. So countries like Japan and China are particularly affected. I don't know how long this will last. I'm not a geopolitical or military analyst, but it points to a deeper structural problem in the oil and gas market, which has to do with about $1 billion a day in sustaining capital investments that haven't been being made. It leaves us very, very vulnerable to shocks like this.
What kind of investments?
The sustaining capital investments are things like recompleting wells who are past their prime, drilling makeup wells in shale plays like the Western Canadian Sedimentary Basin or the Permian. The truth is that the oil industry, in particular state-controlled firms like PDVSA and Pemex, have been underinvesting substantially. It doesn't necessarily impact their production in 2026, but further out, 2028, 2029, it has what is probably an irreversible impact.
How long would it take if the Gulf production does stop within a few days for something like that to restart? What does that look like?
Oh, that's truly ugly. If you take down Gulf production, never mind sustaining capital investments, there needs to be all kinds of new capital investments. I think that's off the table, really. We'll have to make do the best we can with regards to the Straits of Hormuz. As I say, I'm no military analyst, so I don't want to be a doomsayer. I don't know how long the shutdown will last.
The U.S., of course, has reserves like most countries do. Would that be an option for Washington in offsetting the spiking cost of gas right now?
I think it absolutely will. It'll become a political issue in the United States. The United States is a very large liquefied natural gas exporter, and I suspect that it would be in Trump's political interest to divert what is currently export loadings to the U.S. market, should that become necessary.
And do you think that is a play that could perhaps hear about soon?
I'm sorry, I didn't hear you.
Do you think that is something that would be decided on soon?
I don't know the answer to that. I think that the political damage from what's going on in the Gulf hasn't been extreme enough that Mr. Trump would need to take that step. But certainly he would do whatever he had to do to maintain his own political popularity in the United States, including probably deprive our export partners of the gas that they've come to become dependent on.
As you know, Canadians are also looking at spiking prices at the pump. And I'm wondering if Canada can fill part of the gap for the U.S., or would they even be needed to do that, considering, as you say, there's enough in the U.S. if they turned away from exporting some of it?
We would have needed both countries to debottleneck our infrastructure, including things like the Keystone Pipeline and Northeastern Access pipelines, in order for that to have any near-term impact. My own belief is that U.S. supplies are adequate, but the Canadians really need to look at the opportunity they have, particularly in the Pacific Rim, where not too long ago, the belief in Canada was that there was, quote, no business case for Canadian natural gas. The circumstance that we're in today points out that there probably is an extraordinary business case for Canadian hydrocarbons on world markets.
Let's talk about Venezuela as well for a moment. A lot of oil came from that country after the U.S. moved in. Is that easy enough to refine? Is that useful at this point in the U.S.?
It's useful in the U.S. because the U.S. refiners were geared up for heavy crude from Venezuela and Mexico before political difficulties deprived us of that crude. They're less marketable on global markets. One needs to understand that as ugly as the deferral of sustaining capital investments in the rest of the world has been, it's been particularly ugly in Venezuela, where despite having the largest reserves in the world, production has fallen by 85% in 20 years.
Okay, let me ask you about oil stocks for a moment. I'm wondering, with the big push up in what we've seen over the last week, would you chase oil stocks right now?
It depends on whether you own them or not. If you're going to own them for the next 10 years, there are structural reasons why the oil market goes higher. For people who've been acting in a contrarian sense for the last 18 months and already have some oil stocks in their portfolio, they probably don't need to chase them. Loving Exxon at 100 U.S. a share is not the same as loving Exxon at 170 U.S. a share. There's a news trade now that's begun to supersede the fundamental trade.
And do you think the price of oil will sustain itself after being so depressed last year?
I do. I believe, provided that we can sort this circumstance in the Middle East out, that there are adequate supplies in the near term for oil prices to decline back into the U.S. $60 to $65 a barrel level. That circumstance changes, however, 2 or 3 years out, where the previous mentioned deferral of sustaining capital investments means that we will ration by price in the longer term.
All right, Rick, we're going to leave it there, sir, but appreciate you joining us on the program. Thank you.
Thank you.
Coming up, with the rising tension in the Middle East, we're having a look at the Canadian dollar and whether a longer-term gain could be on the horizon. Back in a moment. The conflict in Iran has added some strength to the Canadian dollar this week. Let's start there with Sarah Ying, head of FX strategy for global markets at CIBC. Thanks for joining us today.
Yeah, absolutely.
Where is that strength coming from for the Canadian dollar?
So there's a couple of things. The biggest thing is that oil prices have been rallying since the conflict started, and usually, most of the time, the Canadian dollar and oil prices after the 2014 terms of trade shock hasn't really responded much. But when you do have such large moves in oil prices, the Canadian dollar definitely starts to listen. And that's where most of the rally and the gain and the strengthening of the Canadian dollar is coming from.
Okay, so I know you referred to this as a first phase. What happens next?
So generally speaking, when it comes to geopolitics, I actually think the first phase is really that risk-off move. The market gets a little bit panicky, and then you start to see a haven bid to the U.S. dollar. So This kind of risk off hasn't really been very long in the market this time around. Usually in past events, it's lasted about 2 weeks. Now it's been a couple of days. And one of the reasons why is because the rates market is really keen to price in that inflationary risk. And that all stems back from oil prices moving higher. And this is one of the best weeks for oil prices ever, which is why the market is so quick to respond to that kind of inflationary shock.
Okay, so once the uncertainty fades, and we don't know when that will happen, and we're speaking here
Yes.
about the uncertainty that has to do with the Middle East conflict as opposed to others, you
Yes,
say then
absolutely.
the dollar could sharply pivot lower again. What would that trigger look like?
One of the things is the de-escalation of the conflict is probably going to be the major trigger. Another possible trigger would be if, let's say, the U.S. data is meaningfully deteriorating. We did see a not so great non-farm payrolls report today. So if we do see the data kind of worsen a little bit in the US and the Fed has to ease a little bit more quickly, that may cause the market to pivot from trading kind of buying dollars to selling dollars.
Okay, recap for me what happens if oil does stay elevated. We looked at how much it shot up this weekend. We know that's quite a record for oil for recent history. But if it does stay elevated, and at what level would you see the U.S. and Canadian dollar fall back?
I think there's two things here. One is how quickly oil can rise, and the other one is how long it can stay elevated. If it finds some equilibrium, you probably see markets start to ease up a little bit on inflationary expectations. That is actually a more benign outlook for dollar Canada. In that scenario, maybe we see low 135s, not so much kind of far away from where we are now. I think the biggest risk is if you do see oil kind of rally a lot quickly. And if we do see that in the very near term, you can see dollar CAD testing around 134. So that's really kind of the base that I'm looking at.
Okay. Investors are always looking to benefit one way or another. How could they benefit from the strength in currency?
Yeah, absolutely. So one of the biggest things that investors can do is to go long the Canadian dollar on crosses. So, for example, going short Euro CAD is definitely a trade that is in vogue at this time. The European Union, they probably are going to get hurt a little bit from higher energy prices and higher natural gas prices, whereas Canada stands to benefit from those moves. So that's a trade that we like. So going long Canadian dollar against different other currencies.
Okay, so what are the other commodity-linked currencies like Canada?
So the Norwegian krone is another one, but these days, I think that the Canadian dollar is seeing a lot more impact for a couple of reasons. One reason is that over the past, call it several quarters, the carry trade was very much in vogue. That's where investors went long emerging market or higher yielding currencies. And one popular funding currency was the Canadian dollar. So a lot of investors were short the Canadian dollars going into the conflict. So that's why we see a lot more impact on the Canadian dollar versus other commodity currencies.
We talked about sectors like energy benefiting from something like the war in Iran. I'm wondering what sectors are at risk if the loonie stays elevated.
A lot of the sectors that are at risk are sectors that have higher input costs, some things like discretionary, maybe industrials, staples to some extent. Those are the types of sectors that probably are hurt a little bit more. More of these traditional high margin sectors such as tech and obviously energy stand to benefit.
Okay, I'm going to leave it there with you, Sarah. I appreciate you joining us on the program today. Sarah Ying is Executive Director. She's with Strategy for Global Markets at CIBC. Thanks for joining us.
Yeah, absolutely.
All right, when we come back, American employers unexpectedly cut jobs last month. That moved the unemployment rate up. We'll get into the details when we come back. In one of the largest declines since the pandemic, the U.S. unexpectedly cut 92,000 jobs in February. Our next guest says the number delivers a blow, the view of a stabilizing labor market, and the Fed will be a deer in headlights for the next announcement. Let's go to Olu Sonola, U.S. Head of Economic Research at Fitch Ratings. Thanks for joining us today.
Thanks for having me.
You've called this report a knockdown blow. Why?
Yeah, I didn't want to use the word knockout because there's still, it's still very feasible that we may get some sort of recovery over the next couple of days. But it was clearly a knockdown in that, there were signs of stability. Last month, we had really, really good job growth. You also saw that the unemployment rate ticked down from about 4.5% to about 4.3%. So just saying a tick up in the unemployment rate, a tick down in the participation rate, very, very terrible job growth numbers, actually job losses. And you're like, okay, here we go again. So clearly a knockdown. We could still get back up, but it just makes you think, this labor market is weak. And you still have to pay attention to it.
Okay, tell me when you look at the sectors that lost jobs. I know healthcare was a big one. What you get from that? I mean, healthcare was a big one, but we know there was also a strike of healthcare workers in 2 states. Does that make you less worried about that number?
To some degree, yes. I do think you just mentioned healthcare. There was a strike. Also, the weather too probably played a role with construction jobs and also leisure and hospitality jobs. And if you take those out, you're probably still thinking flat growth overall. If you also take a 3-month average, it's basically 0 job growth. So that is where we are. It's not quite bad because we're not hemorrhaging jobs significantly, but clearly low hire is no longer low hire. It's kind of like no hire. And fortunately, companies are not firing. So we're in some sort of equilibrium.
What is a hemorrhaging number for you?
I would say if you start to see 100K decline on a consistent basis, that will be hemorrhaging. That almost gets to you thinking, okay, what are we going to call this? You can't say we're in a recession of any sort because you're still seeing pretty good growth from an economic standpoint. But if we start to consistently see negative numbers, that's 6 figures, that's a problem.
Okay. Does this number, and you said an average of basically no growth for the last 3 months, does this change the deliberations for the Fed, do you think?
I think so, because, I was actually, I'll put my hand up and admit that I was thinking, okay, with some sort of stability, the Fed will be able to focus a little bit more on inflation, given that it's been about 3%. But clearly now, they probably won't know where to turn. The data is very choppy. The data is very noisy. And you're thinking, okay, I'm going to have to wait. I'm going to have to be cautious. I have to wait to see how this pans out. So certainly March is completely out of the question. Right after that, you have June. That's really when the Fed chair, all things being equal, should be in a seat. Will they cut rates at that point? Probably not. So you now have to keep pushing it forward. And you're thinking, even if they're going to cut rates, it may be towards the second half of the year.
Okay, so let's talk about or add in spiking oil prices, spiking gas prices as a result. To that picture of employment weakening, what kind of impact do you see both of those having on the U.S. economy?
The primary transmission channel is inflation. I mean, certainly inflationary, headline inflation will inch higher just a little bit. Clearly, the Fed prefers to focus on core. They tend to ignore the volatility on the food and the energy side. So the first port of call, I would say, is inflation. Second, I would say sentiments in general. Gas prices, you see those as you drive everywhere. It doesn't help consumer sentiment. And to some degree, the volatility, the geopolitical situation in the Middle East also does not really help business investment. And finally, you now have to also think about the impact on the markets. Markets have been quite volatile. U.S. a lot less compared to many emerging markets. that matters, right? If you start to see a lot of volatility in the US and you're starting to see downturn in the markets and it creates that fear, then consumers could pull back and you could see that dent on growth.
Okay, Olu, I've got to leave it there. I'm out of time. But Olu Sonola is U.S. Head of Economic Research, Fitch Ratings. Have a good weekend. Thanks for your time.
You too. Thank you.
Prime Minister not ruling out participation in that U.S.-led war on Iran. Mark Carney is not called for military intervention, but the Canadian Armed Forces is working on contingency plans. CTV's Judy Trin reports on preparations.
As the war in Iran escalates, the Prime Minister has not ruled out military participation.
One can never categorically rule out participation. We will stand by our allies when it makes sense. There's a distinction between the offensive actions that were taken and are being taken by the United States and Israel, that were taken by them without consultation with Canada, with other allies.
For now, the Canadian Armed Forces is focused on keeping 200 members out of the line of fire.
We've been focused on the force protection of our people, which means dispersing and staying in locations if the force protection is acceptable. In some cases, relocating them to a different country in the region, or in some other cases, redeploying them to Canada.
So far, about 20 personnel have returned to Canada. The federal government has not yet requested help in extracting citizens from the danger zone, but the military says it is preparing contingency plans.
We are in the process of deploying 6 people as liaison officers to make sure that we're prepared should such a request come in, but we do not have any such request yet, nor have we moved major assets like ships or airplanes.
In Canada, there is support for toppling the Iranian regime, but both the U.S. and Israel began bombing without engaging the United Nations or its allies.
It should be up to Parliament itself to say yay or nay on whether or not we're ever going to be deploying our troops into a conflict.
The military is preparing for all possible outcomes, but at this moment, they have not been asked by the government to join Operation Epic Fury, nor have they been asked to help with civilian evacuations. Judy Trin, CTV News, Ottawa.
Let's have a last look at the markets before the end of the trading day and the end of the trading week. Not been a good one for the North American markets. The TSX in particular, it's down over 1.5% right now. That's a 527-point drop on the day to 33,082. Let's go south of the border and have a look at the S&Ps, down 1.4%. Dow Jones just under 1% down today, and the Nasdaq 1.6% down. All of this, of course, the result of both the Iran conflict and what employment numbers in the U.S. We're back in a moment with the closing numbers. Here are the closing bells for the end of the trading day. At the Nasdaq today, Plug Power ringing the closing bell. In New York, the Next Seat ringing the bell. For the TSX, it's ACL Construction to celebrate the company's new listing on the TSX Venture Exchange. You're watching The Close on BNN Bloomberg. I'm Morello Fernandez. Here's how we ended the day on Bay Street and Wall Street. North American markets got hammered again today with the sour U.S. jobs report and the Middle East conflict happening. The TSX Composite down 1.6%. That's a 526-point drop on the day. The S&P 500 is down 1.3%. The Nasdaq down almost 1.6%. Taking a look at oil, West Texas Intermediate, a big gainer from that conflict in Iran. It's up over 12% today. That's a $9.75 move, up to $90.78. It's the first time in a long time it's been that high. Let's take a look at some of the other movers in the markets. Materials and energy moved a lot in Toronto for sectors. Let's have a look at Aecon Group, which gained 7.5%. Taking the stock price to $40.41. Constellation Software is a gainer today. It's up about 6%, just short of that. That's a $166 move for Constellation, which has been pretty depressed on software concerns. In the red, Algonquin Power falling today, 11.5% on debt and operational concerns. Linamar, maker of car parts, also down today. It reported earnings this week. Stock is down over 7% today. A couple in the U.S. we are keeping an eye on. Marvell Technologies is up today. It's up over 18%. It reported earnings this week as well. Stock price ending the day at $89.46. And then let's get to the Gap. It is down 14.4%. That's $3.92 a share to $23.28. A softer Q1 outlook for this company. Let's bring in Bloomberg's equities reporter, Stephanie Hughes. She's been looking at what's moving in Toronto. Stephanie, good to see you. Aecon reported earnings and investors liked what they saw. Tell us about it.
Hey, Marilla, happy Friday. Yeah, so they definitely did like what they saw with Aecon Group. Those shares gained by over 10% at their highest point, which was enough to bring the stock price to its highest levels since 1991. So it's been a while since we've seen the share price at these levels. It was also the top performer on the TSX for most of the trading day today. And like you alluded to, Aecon Group, the construction and infrastructure development firm, they reported an adjusted earnings beat of 52 cents per share. That came well ahead of what analysts were expecting, which was closer to 31 cents. Then you had the analyst team at TD Cowen that said that the revenue growth was solid, and encouragingly, the project losses were lower than expected. The team added that they continue to like Aecon's positioning and growth outlook, especially with the amount of backlog that they have, which is a way of gauging the demand for their services. And this is kind of happening against a backdrop of more infrastructure spending from all levels of government in general, and that's been helping Aecon for the past year or so. So on a one-year basis, those shares are trading over 120% with a 120% gain. So it's holding its own. It's doing pretty well with just this much focus on infrastructure development, Marilla.
Okay, so as we spoke about, we're seeing energy stocks, of course, gain with what's going on in the Middle East, but Algonquin Power not benefiting. Why not?
It's not, because it's a disappointing earnings print, and let me get to the details of that. But the stock fell by 14% at its lowest point, which was its biggest drop since November 2022. So Algonquin renewable power firm, the company cut its 2027 earnings per share guidance based on this expectations of a higher effective tax rate. So analysts largely said that the results were mixed or in line. So it really wasn't the results themselves that were disappointing. It's just that forecast that is really punishing the stock today. So Scotiabank analyst Robert Hope said that the company will be looking for different ways to kind of mitigate this impact, but it's really unclear whether this issue will extend beyond 2027 and potentially into 2028, which would signal a wider problem. And TD Cowen said the company is trying out different tax methods to kind of put a lid on the problem a bit, but those benefits aren't expected to really manifest themselves until after 2027. So it's going to be an issue. So it should be noted that the company's shares were actually trading fairly well on a year-to-date basis, and it was today's drop that put it modestly into the red. So I'd say on a year-to-date basis, it was mostly flat or just a little bit in the red. But it's been, it's not. This isn't building on a further decline for the company this year. It's just so far a one-day double-digit drop, Marilla.
All right, a one-day mini bump in the road for them. Bloomberg, Stephanie Hughes, with that update. Thank you very much. Have a good weekend.
Thank you.
Coming up, as we mentioned, oil surging today. That was after Qatar's energy minister said he expects all oil and gas exporters in the Gulf to stop production in days because of what's going on. Back in a moment. The price of oil surging today after the energy minister from Qatar told the Financial Times that production of oil and gas in Gulf states could stop within days because of the U.S. and Israeli war on Iran. Of course, bombs are flying. Take a look at West Texas Intermediate. It's up over $90. Can't remember the last time we saw it at that point. So again, if that happens, there could be an incredible fallout as a ripple effect takes or settles in. Let's go to Brian Kesslins on the senior portfolio manager with Tortoise Capital. Brian, are there concerns about sustained pressure on oil and gas where you are?
Yeah, I definitely think that is the case. I think everyone is watching the production of oil, natural gas, the form of LNG, and then even natural gas liquids, the production there in the Middle East. And maybe not, obviously, the production can still happen, but how are you actually going to transport those volumes, those molecules out when you've historically gone through the Strait of Hormuz? And that is more or less closed at this point, or at least no one is willing to take the risk to make that transit.
Not only that, but I guess supplies already backed up in the Strait of Hormuz with everything that has happened this week. So it's going to be a lag on that as well. And we know after what happened with the pandemic, once a supply chain gets a kink in it, it can take a while for that to work out.
Yeah, for sure. I mean, in the Middle East in particular, we have a lot of nations, a lot of companies already starting to shut in production. Fortunately, they're able to do so in a very methodical manner so that when they do bring the facilities back online, they can take a more measured approach in doing so. But nonetheless, it does take weeks. In a lot of cases, to bring an LNG plant, Qatar has said it will take weeks to bring their plant back up online. So, yeah, it doesn't just happen overnight where you just flick a switch.
It's only been 1 week, not even actually. At what point do you start worrying about the effect on inflation with the price at the pump spiking for North Americans?
Yeah, I think we're already seeing that at the pump. The gas stations are not not in the mood to wait before they actually increase prices. And I think we're already starting to see some inflationary pressures, not only in the U.S., where, frankly, given our position relative to the rest of the world, because we are the largest producer of energy, our prices certainly for crude are higher, gasoline are higher, but our prices for natural gas actually are relatively flat on a week-over-week basis. So we're fortunate there. But I think as you look internationally, that pressure on inflation is going to be even more so.
Okay, so let's talk about ways investors can benefit from this. Those who have been holding on to oil stocks are pretty happy because the price of crude has been depressed for a while. They didn't see really any growth last year. So how would you play this right now? Would you put new money into oil, or which way would you go?
Yeah, I think energy presents a great opportunity right now, and we think even for the remainder of this decade as well. Right now, our sense is the market that is the most interesting is the LNG market, where Qatar in particular, they supply about 20% of the world's natural gas in the form of LNG, and they've essentially shut their facility. So the LNG market, we've seen LNG prices spike pretty materially. Is really looking to the U.S. to try to add any more LNG supplies to the market. The largest U.S. pure play LNG exporter is Cheniere Energy. We think Cheniere Energy is really interesting at this point because of that. But then some of the larger integrated companies also have a fairly material LNG business, notably Exxon and Chevron.
Okay, so do they have both the capacity and ability? Do they have reserves that they can put out? Do they have a way to get them out to the places that they need to? Can they essentially pump that up?
Yeah, we think that they can do a little bit. Historically, LNG facilities have been able to operate, at least for a period of time, above nameplate capacity. So we think that there is some capacity for them to put some more LNG on the water and into the market. I would say, though, to your point, it is limited in the U.S. in that, for the most part, all the U.S. LNG exporters were operating, for the most part, already at full capacity. But we do think that they'll find some ways to get more molecules on the water.
Would you do that now, meaning put more or new money into natural gas, or would you kind of wait from that signal from the Gulf that they have to shut down?
Yeah, we would go ahead and put the money to work. We think that this is an opportunity, but we think that opportunity is not only because of what's happened more recently, but even over the longer term, as it relates to natural gas in particular, electricity demand, not only in the U.S., but globally, continues to grow. We think that electricity demand, by and large, is going to be met with more natural gas-fired power generation, which is going to increase LNG demand for the next 5 years. Cheniere, in particular, has talked about having $30 per share in cash flow by 2030, which we just think is a really attractive proposition.
Got it. Brian Keslin's going to leave it there, sir. Have a good weekend. Thanks for your time.
Thank you. My pleasure.
So the U.S. markets trended down, as you saw, investors digesting both the unemployment data and rising tensions in the Middle East. We'll talk about other ways investors can move forward when we come back. The U.S.-Israeli attacks on Iran have triggered a regional crisis and sent energy prices skyward. Now, in the U.S., the American president's decision to go to war could also hurt his party in a midterm election year. Our colleagues at Bloomberg took a closer look.
When we look back at this war, people will see it as a game-changing event for the region. There hasn't really been a precedent ever in history where the response out of Iran has involved as many countries as we're seeing today.
We'll never be threatened by a nuclear-armed Iran.
There are multiple political risks for Trump. It's arguably the most definitive decision and move that he has made since coming into office for the second time.
With the big U.S. military buildup that had occurred, there was an assumption that there would be some form of military action.
One of the tenets of that America First policy was no new wars. And now he started a war.
Everyone in this region, including the Gulf states, had underestimated the scale and the breadth of the Iranian response.
The president campaigned as a candidate in 2024 as someone who upheld the America First policy. And it's important to note that he's started this war in the middle of what is an election year.
I think one of the biggest fears is the unintended consequences of pursuing a war without a clear objective.
The biggest political thorn in his side, at least as far as his base has been concerned, is the Jeffrey Epstein files. But Iran has the potential to be high up on that list, potentially equal with that. The president was supposed to be, according to his advisors, spending the next several months doing a multi-state domestic tour talking about his economic record. The opportunity, I think, presented itself.
This was our last best chance to strike.
The president decided that this was the window to do it and made very clear that he wanted to see what he called regime change.
We're finding ourselves in, if not the worst case, very close to one of the worst case scenarios that these Gulf states had been actively trying to avoid.
It came at a time when the economy in Iran was weak. There have been protests, which of course the Iranian government had worked to tap down. Iran may be creating its own political risks by responding to the US and Israeli attacks by attacking its own neighbors.
The assumption in prior episodes, whenever Iran had been attacked or come under attack, was that it would direct its response at Israel or very targeted U.S. assets in the region. Gulf states won't have an endless appetite for this war to continue as the costs continue to mount. It has led to the effective closure of the Strait of Hormuz. About 25% of the world's seaborne oil passes through this choke point. Now here's the typical traffic for oil tankers. Now look at the drop right after the first strikes began. Vessels are choosing not to pass through it. Shipping costs have gone up between 50 and 100%.
There's the economic risk, which then has a potential impact on the elections as well. And that is, if the fallout from this war leads to higher oil prices, and that translates to higher gasoline prices, then that takes away a really, really important talking point for President Trump that will hurt his chances of maintaining Republican control of Congress. So far, you've seen pretty robust support from Republicans. If this war has broader economic implications, then you might begin to see Republicans who are eager to be reelected distancing themselves from this president.
For the Gulf states, the priority here is somehow to bring down the temperature. And perhaps the off-ramp could come from using their political personal leverage with President Trump. A lot of this is guessing, and at this point, there are no signs yet that the system is beginning to change on the ground within Iran.
Bloomberg colleagues reporting there all week. Of course, we've been watching that conflict turn over the markets. Let's get into how this is playing out in the U.S. with Matt Gertken, Chief Geopolitical U.S. Political Strategist, BCA Research. Thanks for joining us today.
Thank you for having me.
The big question seems to be right now, is there an off-ramp for Washington? Because it's still not clear what the end goal is. Is that perhaps because the end goal for the U.S. is not necessarily the end goal for Israel?
Well, I do think it's true that there's a divergence. I think Israel certainly wants regime change, whereas the United States is willing to be happy with destroying the nuclear program and then having personnel rotation, which they have achieved. The ballistic missiles and the Navy of Iran have also been effectively destroyed. And so the U.S. is closer to a point where they can say that they've sufficiently deterred Iran from behavior that they weren't liking over the last 40 years.
Okay, so they weren't liking, but are Americans supportive of their motivation here? Donald Trump had mentioned an imminent threat to America. Some were saying the nuclear programs were far from that, especially after the hits last June. Do Americans support the message around this?
It seems very partisan, as with so many things in the U.S. You have about 40% that do approve of the war, maybe 50% disapprove. But the numbers in the polls tend to be fairly closely in line with the core base of support for the Republican Party versus the base of support for the Democratic Party. And when you ask about the nuclear program, that tends to shift the polls a little bit in favor of the president. So in other words, there was a long-term risk of a nuclear-armed Iran backed by Russia and China, and Americans sort of understand that the U.S. needed to prevent that from happening, but there was not an imminent threat. And so there is a lot of hesitation because we've had some long and deleterious wars in the Middle East and in South Asia over the past 2 decades.
Yeah, Americans, I know, did not support sort of boots on the ground initiatives. Gas prices are also a sensitive issue for consumers. They're spiking here. Have they moved up there?
Yeah, the gasoline price is actually moving up, although, you know, with the latest moves in oil and with Kuwait as well as Iraq shuttering in their production and the Strait of Hormuz remaining closed, you can sort of anticipate that there will be a continued effect. You'd have to have a sustained oil price well above $90 per barrel to translate to the gasoline price getting to $4 per gallon in the U.S., which is sort of the political period where people really would break their opinions of Trump. You'd start to see his approval rating sink down into the 30% range. And that would be a disaster ahead of the midterm election. So it does suggest that the president is getting closer to declaring victory and trying to resume negotiations rather than creating irreparable economic harm.
You mentioned it'd have to get closer to $4 a gallon. Where are they around now?
Oh, I mean, anywhere from $3.20 to $3.50, I would say. I mean, it really depends on where you are.
Okay, so how quickly will Washington have to move as that gas price edges up?
I mean, I think he's going to be moving now. So, for example, when the president gives a very harsh claim, you know, quoting Ulysses S. Grant, the U.S. demands unconditional surrender, what he's saying is he's going to pressure the negotiations sooner in order to try to either shift his rhetoric over the weekend or sometime next week, because with one more week of the type of behavior we're seeing in the Middle East, and you'll see the oil spike, above $100 per barrel, and you'll get a lot more panicking in global markets, and you'll get a lot of downstream impacts, and it'll just be harder and harder to manage.
Yeah, let's talk about some of the downstream, because energy prices are one thing. Where do you see this rippling to? What other supply chains, for example, could be affected?
Well, generally speaking, all forms of fuel are going to use this crude oil as their inputs. But you also see that aluminum has been impacted. You see fertilizer, both from natural gas as well as inputs to fertilizer. And you can also have a range of other goods affected. So it's it's a supply shock, and it does cross different layers of the economy. But the really key thing is crude oil, because it's just such an essential good, and it translates to so many other types of production.
You mentioned, of course, it's a midterm year, so clearly they would have to move faster this year than they do in other years. It feels like it's already a tight timeline. It's March, and the midterms are in the fall. Is that already a tight timeline for the president to get out of some of this mess?
Oh, yeah, extremely tight timeline. I mean, voters typically make up their minds in the summertime. July, August, a lot of voter opinion has been formulated already. And so if you have a price spike that occurs in March, you have to get that price spike down by Memorial Day, end of May, so that people can start having a good summer. Otherwise, they're going to be very resentful, because they'll be paying higher prices, whether it's for food or fuel or just for getting by in life. Shelter, of course, is an issue. So really, it was a huge gamble. And the United States and Israel believed that they had a strategic opportunity that they had to take, because Israel and the U.S. saw that Iran was extremely vulnerable. But the timing was not great for the president, given the midterm election.
All right, Matt, I'm going to leave it there. Thank you for your time. Matt Gertken with the latest on the conflict and what it means for Americans. Thanks for that. Straight ahead, a new report sheds light on how American tariffs are impacting provinces across the country. We're back in a moment. Here are the stories we are following today. Prime Minister Mark Carney has signed a deal with Japan to expand energy trade and military cooperation. It also outlines a pledge to increase the flow of liquefied natural gas and liquefied petroleum gas to that country, and for the countries to work together on nuclear and clean energy projects. The U.S. economy saw a decline in jobs last month after a strong start to the year. The data from the Bureau of Labor Statistics reporting 92,000 positions were lost last month. Economists were expecting a gain of 55,000. The unemployment rate climbed to 4.4%. The decline in jobs partly reflected a drop in healthcare employment because of a strike. Shares of The Gap were down today. The clothing retailer reported fourth quarter sales and profit that came in below expectations. Two of its apparel chains underperformed, Old Navy and Athleta, which are the company's largest and smallest brands, respectively. They both missed some same-store sales estimates. On the upside, Gap and Banana Republic did beat expectations, and the company's forecasting better than expected profit for the year. Shares of Martin Ray International falling today after the auto parts manufacturer missed on revenue expectations for its most recent quarter. Sales outside of North America and Europe also fell 17% compared to the same period the year before. The company posted profit that beat estimates and saw sales rise in North America and in Europe. A new BMO report sheds light on how U.S. tariffs are impacting provinces. It highlights which regions are facing the most economic pressure and why certain sectors are more exposed than others. Robert Kafzik is senior economist at BMO Capital Markets, and he joined us on this.
If you look at what the most significant tariff burden is right now, it's sectoral tariffs on things like autos and steel and aluminum. So you just take the really simple next step and say, well, where is most of that stuff produced? It's obviously Ontario, Quebec, and in the central Canadian manufacturing base. The flip side is you look at industries where the exposure is really relatively light, like, let's say, oil and gas and resources. The vast majority of those tariffs, of course, stripped out by coverage we already have under CUSMA. And then you have provinces like, the Albertas and the Saskatchewans where where, there's not really much of an incremental impact from tariff changes at all at this point.
So it looks as though Ontario, by your numbers, lagged the Canadian growth rate last year and in 2024. Although for this year, it looks like you see Ontario not falling too far short. You see not great growth of about 1.2%.
Yeah, so we would still have Ontario and Quebec running at or, very slightly above 1%. So a couple tenths below what the national average is looking like. Mm-hmm. And I think the bigger takeaway here is that we came out of a period where the provinces were really experiencing a lot of the same economic fundamentals at the same time, right? We came out of the pandemic, everyone was growing, everyone was seeing incomes rise, everyone was seeing job markets tighten up. And now for the first time, we're really starting to see those conditions break apart a little bit. And so, you can conceivably have a province like Alberta growing at, 2.5%, comfortably above potential. And at the same time, you have central Canada really struggling to grow more than 1%. And we haven't seen this kind of disparity in quite some time across the Canadian landscape.
Remember, I was in Prince Edward Island years ago, and we were driving to get oysters or something, and I remember thinking, this is great. There's no traffic. It's not like Cape Cod where everything is crowded, and why not just go here all the time? So you think Atlantic Canada, for one thing, could get a boost from stay in Canada tourism?
Well, there's that aspect, sure. And anecdotally, like last summer was a pretty strong summer from a tourism perspective, just as a lot of Canadians were staying at home. There's also, a lot more going on to kind of shape this regional dispersion than just tariffs themselves, right? So the housing correction is another factor, which is hitting disproportionately hard in Southern Ontario and parts of British Columbia. To your point, there are markets like Calgary and especially Atlantic Canada where we're not really feeling much of that at all yet. And in the case of Atlantic Canada, like you mentioned, no traffic, I think that has changed quite a bit, to be honest. And yeah, and that's a market that is just really still scrambling to catch up to a period where we had, 2, 3, almost 4% population growth in a region with a really small population base. So the correction that we're seeing on the ground in something like residential construction in Southern Ontario is just not necessarily applying in a market like Atlantic Canada right now because there's still so much catch up going on.
I'm just looking at the budget deficits, the shortfalls. New Brunswick, a small economy, relatively speaking, but a big budget deficit this year, 2.7% of the province's GDP.
Yeah, and that's kind of a theme we've seen so far. We only have, I think, 3 budgets out for fiscal 26, 2027. We're going to get the rest of them over the next month or so. But we saw British Columbia come out with, 2% of GDP or more in the deficit. New Brunswick, as you mentioned, even Alberta pushing almost $10 billion on their deficit. So if there's a really early message here from the provinces, it's that we saw a pretty sizable deficit last year. It doesn't look like it's going to narrow all that much. Maybe with the exception of an Alberta and a Saskatchewan, and this kind of just reinforces that there probably is even more disparity kind of shaping even at the fiscal level when, we're talking obviously about an oil price shock this morning a lot with WTI pushing $90. Well, a couple of weeks ago, Alberta put $60 for WTI in that budget. Yeah. So, right. So within a matter of weeks, we've almost swung the outlook there from a $10 billion deficit to what could very reasonably be a $5 or $10 billion surplus. And that's how quickly the fiscal situation in a province like Alberta can swing around.
And Alberta is still seeing quite a few Canadians moving from other provinces.
Yeah, and so that would be the other really big macro factor that's kind of reshaping the regional growth landscape. It's that the population caps that the federal government has put in place are not necessarily landing uniformly across Canada, right? So if you think about caps on non-permanent resident flows, somebody like a British Columbia or an Ontario where the share of non-permanent residents is well above the federal target, right? 7-8% of the population in those provinces, they're going to disproportionately see a much more significant slowdown in population growth. And on the flip side of that is, Alberta is a market where non-permanent resident levels are pretty close to federal targets. But as you mentioned, there's also movement within Canada. And that's a province that continues to attract population flows from literally every other province in Canada when you drill down into the numbers. It's partly the fact that, look, if the economy and the job market in central Canada is struggling under the weight of tariffs, well, the Alberta economy is still growing at a pretty solid clip, and the relatively healthy resource sector is still hiring. And there's a big affordability trade still that's going on as well, where you have households kind of moving out of the Vancouvers and Torontos into more affordable markets.
And just finally, you touched on this, the impact of tariffs, but Quebec is really going to suffer this year, you guys reckon. Growth of less than 1%?
Yes, and it's part of it is the fact that just the potential run rate for growth in Quebec is relatively low compared to the national average. So the speed limit of that economy, so to speak, is a little bit slower than 100 kilometers an hour anyway. So you're going to gravitate towards lower growth in Quebec. But you're right, when you look at just like the weighted trade flows across Canada and where tariffs have technically hit hardest, it's those really elevated tariffs on steel and aluminum that disproportionately hit Quebec. So the impact on just activity directly, and probably more importantly, just business confidence as we go through 2026. Quite a bit of political uncertainty, to be honest, in 2026 as well, where firms might just be kind of sitting on their hands a little bit until we get more clarity on some of these issues.
Robert Kafzek, senior economist, BMO Capital Markets. Up next, the U.S. Defense Department is officially labeled Anthropic a supply chain risk. The CEO of the company says they'll fight the move in court. More in a moment. The U.S. Defense Department has officially labeled Anthropic as a supply chain risk and has asked defense-associated companies to cut ties with the company. The CEO of Anthropic says they'll fight this move in court, calling it not legally sound. Let's go to tech analyst on this. Carmi Levy joins us now. Carmi, is this a fight Anthropic you think can win? Because it's an interesting one that could pave guidelines for the use of AI down the road.
I mean, it ultimately determines which direction the AI industry goes in. I mean, the federal government, the Pentagon, the Department of War, in forcing the company and within its contract to open the door to using its technology for AI-controlled weaponry, AI-controlled military engagement, as well as allow it to be used for mass surveillance domestically. That violated a whole lot of the company's own red lines, as well as a number of red lines that industry experts have been warning about for a very long time. Remove humans from the kill chain and bad things can potentially happen. So, this isn't just about the future of Anthropic and their Claude platform. It really is about the future of, will AI be used in military to, get us to those dystopian Hollywood predictions we've all been fearing. If the company loses this one, all bets are off.
Yeah, and already I know they've asked some of these companies to move away from Claude. Do you think that this will get heard in a reasonable amount of time, and then perhaps we'll get an answer? This is the kind of case that could move up because it needs to be resolved?
I think it'll have to be, because operationally, I mean, the Pentagon will already use this technology even after the president had said they're a supply chain risk. They went ahead and used the technology as part of their planning for the Iran attacks, and so I think there's a reason for expediency here for the court to prioritize this case. It needs to be adjudicated, and quite frankly, every other technology company and specifically AI company is watching this very closely. OpenAI, for example, which has stepped into the breach, they now have the contract that Anthropic used to have. They are in fact now suffering. There's a customer revolt, there's an employer revolt over the use of their technology for these militaristic purposes, and so the entire industry kind of hangs. It's almost like a pivot point here, and it all depends on the outcome of this court action.
Yeah. Let's get to another story. Meta wants to get in on AI-led shopping. So how does it plan to incorporate this onto its social media, and do you think it's a good idea for them?
I don't think they have a choice. I mean, at some point, we're not going to be using social media all the time, every day, all day, to scroll through or doom scroll our feeds. We're spending more time on AI platforms, and so the e-commerce function that exists within social media, such as it is, it's going to have to rise to compete against shopping options that OpenAI and others are already building into their chatbots. And so the way it'll work is that it'll take the Meta AI platform, which is already integrated into most of Meta's tools, and it'll add a shopping research button inside the query. So when you search for things, you'll also be able to look things up, and there will be a catalog of options for you. You won't be able to buy it within the Meta tool. It will take you to a link that's external. So in a certain sense, this is not a complete e-commerce solution. It's a bit of a stopgap while the chatbots race ahead with their own e-commerce solutions. I can already tag certain partner vendors from within ChatGPT for an e-commerce experience, and everyone is signing up for that. This is kind of Meta playing defense. They don't have a choice. They're going to have to come up with something better.
Okay, let's get to restaurant brands. They're going to roll out a Patty AI assistant. Get it, Patty AI, at Burger King. But really, it kind of sounds like it's just an upselling assistant. What's your take?
It sort of is, because it's built into the headset that in-restaurant employees will use, and so it'll listen to their interactions. It'll suggest when they should be upselling. Do you want fries with that? It'll suggest what they should be doing when certain inventory runs out, and it'll even remind them to smile. And so it all sounds fairly innocuous, but really it's collecting information to train a very specialized restaurant service bot that at some point could potentially remove the need to even have employees in that space to begin with. So it's a massive data collection opportunity for RBI. They're starting it in Burger King, but clearly this could easily be rolled out to their other constituent properties, Tim Hortons, Popeyes, and others. So this is what the industry needs to do. McDonald's brought in those kiosks that now include AI as well. And at some point, you are going to walk into a fast food restaurant. There won't even be someone there standing there with a headset. It's all going to be technology all the time. Shareholders love this stuff.
Okay, except that when McDonald's rolled theirs out, I think the AI at the drive-thru made more mistakes than humans do. Do you think that has been resolved since?
Yeah, it's a question of, where are you on the technology curve? And McDonald's introduced this technology in the drive-thru in 2021, when obviously AI was not clearly as refined. The models weren't as thorough. It wasn't as ready for real-world application as it is today. And they ultimately killed it in 2024. But at some point, it is going to get reintroduced, not only in the drive-thru, but everywhere else. And I think at some point, McDonald's is going to go for version 2.0. The technology simply needed to mature. It wasn't back then. It certainly is now.
All right. Carmi Levy, good to have you on this Friday. Thanks for your time. Have a good weekend.
Appreciate it, Morello. You as well.
All right. Coming up next, Hot Picks. We will zero in on 3 plays in specialty retail when we come back. It's time now for Hot Picks. We looked at some plays in specialty retail, starting off with National Vision Holdings.
Retailers in the U.S. Their main 2 concepts. One's called America's Best Contacts and Eyeglasses. The other one is called Eyeglass World. They've got, call it 1,100 stores, and they're nationwide, quite frankly. And they're value retailers, so they tend to undercut a lot of their competitors on price. Now, to be very clear, smart glasses is just one part of the thesis. It's actually a relatively small part of the thesis, but you are correct. They are selling the Ray-Ban Meta smart glasses. They have them in about 300 stores. They're going to roll that out chain-wide by the end of the second quarter. But there's a lot of reasons that we like this stock aside from smart glasses.
Right. So they just in regular eyewear, then they tend to be price is one of their propositions here.
That's correct. So they are the low price leader by a very, very wide margin. So they will undercut certainly like a Pearl Vision Center or a Lens Crafters, but even like a Costco or a Walmart. I mean, no one really sells eyeglasses any less expensively than National Vision does. But, look, there's a lot of reasons that we like this stock. First off, look, glasses are a medical necessity, right? They're non-discretionary. So we expect glasses sales to hold up much better in a sort of middling macroeconomic environment. They also have new management, and the new management team has just a raft of initiatives. I won't bore you with all of them, but one of the main ones is that 42% of their sales are covered by vision insurance. Historically, they weren't basically maximizing vision insurance benefit. So in other words, I'm a vision insurance customer. I have a benefit of $140. I can spend up to $140 on frames without paying $1 out of pocket. They were selling those folks the same way that they were selling folks who just walked in without vision insurance. And their ethos was try to get the customer out at the lowest possible price. So they would sell that person $100 worth of glasses when their benefit was $140. They're not doing that anymore. And that's just one of a number of other initiatives. They have a new advertising campaign. They're adding higher priced frames to their stores. They're doing a better job of converting in the store. So just better selling tools for their consumers. They're taking costs out. I mean, you name it, they're doing it. And the valuation, even though the stock was up about 170 or so percent last year, and it's off to a pretty decent start this year, is still attractive relative to historical levels.
Let's move on to Warby Parker, because the stock has been moving higher, and smart glasses here seen as a catalyst?
Smart glasses are definitely a catalyst as well, but once again, a relatively small catalyst. So with Warby Parker, basically, they have a partnership with Google and also with Samsung, in which they're going to develop Warby Parker smart glasses using Google's Android XR operating system. But those glasses are not going to come out until, call it like late 2026. So I don't think they're going to have much of an impact in 2026. I think certainly they'll have more of an impact in 2027 and 2028. To be very clear, we are very, very bullish on smart glasses. But with Warby Parker, our investment thesis is just, around the fact that this is a company that has about, 320 or so stores. They think they can grow that to 900 stores in the U.S. There are 45,000 optical stores in the U.S. More than half of them are independents. And similar to National Vision, Warby Parker is a value retailer. So their entry-level price point offer is a pair of frames, single vision, a pair of frames with single vision lenses, and their opening price point is $95. Once again, nobody comes close to that. In addition to that, their stores are beautiful. I mean, particularly for optical stores. Most optical stores are kind of sterile at best, but Warby Parker's stores, I mean, they're kind of like the Apple stores of optical retail. So it is a much more pleasant shopping environment. And they're underpenetrated in a lot of high margin areas. So for example, they sell a much lower percentage of progressives relative to a lot of other optical retailers. They have a much lower percentage of eye exams relative to a lot of other optical retailers. So this is an organic square footage growth story, but there's also opportunities for them to further drive store productivity.
We've less than 60 seconds. Sorry, Anthony. Ollie's Bargain Outlet Holdings, what draws you to that stock?
Yeah, so they are a closeout retailer, the largest closeout retailer in the U.S. Once again, given the kind of uncertain macro folks trading down to Ollie's, and they are, given all the rash of retail bankruptcies over the last few years, so think Bed Bath & Beyond, Christmas tree shops, Party City, they are seeing more and more attractive closeout buying opportunities. They're also buying more direct from manufacturers, particularly in the CPG space. So that's a name we really like as well.
Anthony Chukumba, Loop Capital Markets. The Prime Minister and the Alberta Premier Danielle Smith have reached an agreement in principle on fast-tracking major projects. CTV's Jeremy Charon reports.
This is one step in a long list of commitments made in the Memorandum of Understanding signed between Ottawa and Alberta. The government says today's agreement will help simplify and speed up the process to deliver major projects. But this deal only addresses cooperation between Ottawa and Alberta on environment and impact assessments. It is a draft cooperation agreement that builds on similar deals Ottawa already has with other provinces. The government says it would bring a one project, one review system, creating a streamlined approach for major projects that meets both federal and provincial requirements and ensures the rights of Indigenous communities are respected.
Major projects within our boundaries are going to be governed by Alberta processes. That, I think, restores the original intention of how our country is supposed to work. That being said, we need to have the legislation changed at the federal level. We're grateful for this carve-out, but I think that's another stage of the process.
The MOU had set an April 1st deadline to get this agreement done. Other commitments with the same deadline have yet to be achieved. That includes an agreement between Ottawa and Alberta on carbon pricing and methane equivalencies. as well as a trilateral agreement with the Pathways Project in the oil sands that would see Alberta commit to investing in a major carbon capture and storage project. Jeremy Sherrill, CTV News, Ottawa.
That does it for The Close. Thanks for joining us. Have a good weekend.